Welcome to this explainer. If you've spent, any time at all looking into quantitative finance, you've almost certainly been warned against two cardinal sins. Never curve fit your models and never, ever try to pick tops or bottoms. But what if everything we've been taught about these taboos is actually completely upside down? Today, we're exploring a fascinating framework from Will Duxon over at Price Dynamics. He argues that doing exactly these two things, if you do them with strict statistical discipline, of course, isn't a mistake at all. Actually, it's your ultimate edge.
Here's the roadmap for today. First, we'll be breaking the trading taboos, then measuring market extremes. After that, we'll dive into healthy curve fitting, explore the multi-timeframe zoom, and finally, wrap up with AI and economic relevance. Let's get right into it. Part 1. Breaking the trading taboos. Is this the quickest route to liquidation? So typically, when the average retail trader tries to pick a bottom, they're really just guessing, right? They're imposing their own subjective opinion on the market. But a quantitative specialist like Duxon takes a completely different route. He isn't guessing, he is measuring. He maps out the statistical distribution of price to strictly identify extremes. It's the exact same action, engaging at the very edges of the market, but is powered by objective mathematics rather than just blind hope. Moving on to Section 2. Measuring market extremes and finding what we call the home base. So, what exactly is a home base? Well, this is the center of a price's statistical distribution. Think of it kind of like a rubber band. The home base is that rubber band resting naturally. When price moves away from this center, it stretches, and the further it goes, the more it pushes into the tails of the distribution, entering highly abnormal market territory. By identifying this home base, a trader isn't blindly stepping in front of a freight train. Instead, they're waiting patiently for the rubber band to stretch so far that it simply has to snap back. This brilliantly illustrates the mindset shift we're talking about here. Duxon says, and I quote, "Because when most traders try to pick tops and bottoms, they're fighting momentum. What I'm doing is measuring when that momentum starts to lose structural integrity. That is huge. You see, picking tops and bottoms isn't about calling a reversal in a vacuum. It's about actively monitoring the market to find the precise mathematical moment a move becomes totally unsustainable. You aren't fighting the trend, you're objectively measuring its exhaustion." Section 3. Healthy curve fitting. Noise versus structure. Okay, if you only take away one thing about modeling from this explainer, make it this. Healthy curve fitting models underlying behavior, not historical noise. The taboo against curve fitting exists for a reason, mostly because amateur quants often build models perfectly tailored to a very specific, fleeting historical price path. And what happens? The moment the market changes, that model totally breaks. But healthy curve fitting reclaims the term. It uses historical data to extract incredibly stable, repeatable structures, like how volatility typically behaves, or how trading ranges expand over time. This is essentially a rigorous form of regime classification. When Duxon looks at a market environment, let's say a trend with pullbacks, he notes its orderly, stable structure. Because that specific structure repeats over time, it's considered robust, so we keep that fit. The exact same goes for the volatile extremes of a stretch and snapback scenario. But if a model is just tracking a random historical path, basically just representing fleeting historical noise, well, it fails forward testing across different instruments and gets immediately discarded. You're only fitting your strategy to the enduring mechanics of the market itself, nothing else. All right, Section 4, the multi-timeframe zoom, validating the edge. This right here is the mandatory execution process Duxon calls the zoom, and it's literally what separates high-probability trades from disastrous false signals. Step 1, you identify that your statistical extreme has been hit on a higher time frame, like the 1-hour chart. But hold on, you don't act yet. Instead, we move to Step 2, dropping down to a much lower time frame, typically a 5-minute chart. Finally, Step 3, you examine the microstructure of the price action at that exact moment. You need solid empirical proof that the market is actually reacting to your statistical extreme. So what exactly are we looking for when we zoom in on that microstructure? Well, there are two main validation outcomes. The first is a rejection signal. This is absolutely what you want to see if you're going to take the trade. It means there is a visible, undeniable loss of momentum and a structural breakdown right at your key level. The market is violently rejecting that extreme price. But the second outcome? That's an acceptance signal. This happens when the market hits the extreme, but instead of bouncing off, it consolidates, it gets comfortable, it accepts the new territory. If you see that happen, the reversal setup is totally negated, and you just stay out of the trade. Simple as that. And this highlights a massive misconception about quantitative trading. Indicators are non-lagging alert systems. They are not autonomous entry autopilots.
Duxon loads his indicators in real time to ensure empirical transparency, basically proving the data isn't just smoothed out after the fact. But the indicator is really just a tap on the shoulder, saying, hey, something mathematically significant is happening right now. The human in the loop is always the final arbiter. The trader uses that zoom process we just talked about to confirm the signal, ensuring they're only entering trades where the risk is objectively small and the asymmetrical reward is huge.
Finally, Section 5, AI and economic relevance. Let's look at the big picture.
If we look back at the 20th century, industrial expansion and labor organization were the primary engines that built the middle class. They gave people a real stake in the economy. But in the present day, we're watching automation and artificial intelligence completely reshape traditional employment and labor markets. Those old mechanisms are fading fast. So looking to the future, we desperately need new architectures. Statistically driven systems like the one we've outlined today could literally be the mechanisms that distribute financial opportunity to everyday participants when traditional jobs are no longer enough.
Duxon sums this up incredibly powerfully, because if automation and AI are going to continue reshaping the economy, and they will, then there also needs to be a mechanism that helps people stay economically relevant. You see, his long-term goal isn't just to trade for his own personal gain. It's to build a decentralized, automated trading firm founded entirely on these statistical principles. Imagine a system where everyday people, not just Wall Street insiders, can participate in structured market activity using firm capital rather than risking their own livelihoods. It's all about creating a brand new kind of access.
So we've seen how what we originally thought were forbidden rules can actually be transformed into a rigorous structural edge. By focusing on regime classification, empirical validation, and deep statistical discipline, we can actually navigate the extremes of the market. But as we move into a financial landscape that's increasingly dominated by algorithms and automation, I want to leave you with this question to consider. How will you define and defend your own statistical home base in the age of AI? Understanding these tools is step one, but what you do with them next is entirely up to you. Thanks so much for joining me on this explainer.